Hey folks, welcome back to our senior journey. Today is part 2 of our 5-part series on annuities. We're going to talk about the 5 most common mistakes that people make when buying an annuity. If you haven't watched the first video, it is up on YouTube. That one is how to choose the right annuity for retirement. And also, if you haven't watched the long form webinar recording that we did that a couple of weeks ago, understanding annuities, how they work, and their role in retirement. This 5-part series is a little bit more deeper dive, detailed version of that. So you can get a really good overview in that particular webinar, that particular recording. And then, like I said, we're going to break it down in these 5-part series. So again, today, 5 common mistakes that people make when buying an annuity. Let's get started. Okay, 5 common mistakes to avoid when buying an annuity. So, first of all, annuities can be a great fit, or they can be a costly mistake. And a lot of that really just depends on matching it to your needs and making sure that you understand everything that you're actually getting. And that's what we're going to talk about here. A lot of the mistakes that people do make, because the one thing that I've seen over the years is that one of the biggest reasons people get upset about any investment, whether it's an annuity or the stocks, bonds, mutual funds, ETFs, is because they just don't understand the investment. They don't understand the benefits. They don't understand the risks. And that's usually what gets people frustrated. So my suggestion is just make sure that you take your time, ask the right questions, work with someone who puts your interests first. That's what we do here at our senior journey. We really do care about making sure that you get the right product for your particular situation. If it doesn't fit, if it doesn't make sense, we're not going to try and force that on anybody. I'm in a situation where I'm looking at my retirement down the road. I do this for a lot of people that I know, that have become friends, clients, and our goal, again, is just to make sure that you understand what you're getting into. Okay, so let's start with mistake number 1, not understanding surrender charges. And I think this is pretty common, more common maybe 10, 15, 20 years ago when surrender charges were much longer. But first and foremost, annuities are designed for long-term use. So this is not a product that you're going to, number one, compare to long-term growth of a stock. It's just not apples to apples. That's apples to oranges. So you really have to understand and know that if you're going to get into a product like this, it's got to be a long-term mindset. And that's okay, because a lot of times with an annuity, you're looking at growing an account and then taking withdrawals or taking guaranteed lifetime income. And for that, you've got to go through the surrender charge period. So you need to understand what that exactly means. So there's usually, a fee schedule starting at year 10, and it might just drop down 1% per year over a 10-year period, 10, 9, 8, 7, 6, 5, and so on, percent each year. So in other words, if you surrendered your policy in year 5 and the surrender charge was 5%, you would get 5% taken off the account value and net that out, and that would be the amount that you would get. So over time, that goes away, and once that's gone and gone, it's gone forever, and you don't have to worry about the surrender charge. But you have to be aware of it. And especially, let's say that you've got an annuity and maybe you're not happy with its performance, but you do like annuities in general, so you want to look at another annuity. We do those reviews all the time also, and see if it makes sense with new, better products nowadays than maybe even 5, 6, 7 years ago. Does it make sense to move it? In large part, that does depend on a surrender charge, and if there's one there. So many times, if there's a stiff surrender charge still sitting there, we don't want to really get into it. We don't want to take money out of people's pockets when they can just wait a couple of years and not pay those fees. So what you need to know when you're talking about that, just know the exact length and fee schedule. Know if it's 5 years or 7 years or 10 years. If it's longer, you really need to know that. I don't work with a lot of annuities that go any longer than 10 years. They're typically 7 to 10 years. That's what we see nowadays fitting the best. But definitely see a lot of annuities that are still out there at 12, 15. I still see a couple with 20-year surrender charges. I personally don't touch them. That's just way too long for my own comfort level. And if I'm not comfortable with it for me, I'm probably not comfortable with it for anybody that I'm working with. And then find out exactly what percentage you can withdraw penalty-free each year. Now, that's relaxed quite a bit over the last number of years. So Typically, you can take out 10% per year starting in year 2, but a lot of annuities now allow you to take out 10% per year starting in year 1. Now, keep in mind that's not cumulative. If you don't take 10% out in year 2, and then you want to take money out in year 3, that doesn't mean you can take 20% out. It means you can still only take 10% out. So those are still set in stone with annuities. I haven't seen a cumulative one ever, frankly. Maybe it's out there. I haven't seen one, but that's typically what you can get. So the good news there is it's more liquid than they used to be. They didn't used to have these penalty-free withdrawal provisions in annuities years ago, and that was one of the big hangups. One of the big things that made a lot of people very upset with annuities is because they just couldn't get to any of their money, and that's just simply not true anymore. And the other thing, and I said this, I touched on this, only invest funds that you will not need for short-term goals. So you should always set enough money aside in liquid assets for emergencies, that cash bucket, things like that. Annuities you have to look at them as guaranteed sources of income, just like Social Security, just like pensions. It's just a self-funded pension. It's a self-funded Social Security, for lack of a better phrase. So that number is going to be there for as long as you and or your spouse live. That's what those are designed for. That's if you're annuitizing. We'll talk about that versus withdrawals also. Number 2, misunderstanding guarantees. And this is always, can be very difficult, especially you get, some people will really look long and hard, as they should, at these illustrations. And you see these numbers in these columns that give you an account balance over here and a benefit base over here. What's guaranteed? Is my growth guaranteed? Is my interest rate guaranteed? What exactly does that mean? And you should understand that. And we do walk through that because we walk through the contract. But what's typically guaranteed is it's a rate of return on the income base, not your actual account value. So they have a couple of different columns, and this gets back to insurance companies really understanding actuarial science and knowing, longevity, life expectancy with everybody, the law of large numbers. They take all these people that get into an annuity, and then they understand what percentage they can actually guarantee on what they call an income base. Now, the income base is basically a phantom value. You see it in an illustration, but this is not a number that you can actually withdraw from. It's just the number the insurance company uses to calculate what your guaranteed lifetime income is going to be. And that gets back out to payout rates. We talked about this in the long form video, which is understanding annuities, how they work, and their role in retirement. Highly suggest you go back and watch that if you haven't seen it yet. We talk about that more towards the end with payout rates. But that's important. Another thing that's guaranteed typically is the floor. Remember, we've talked about that before, the 0% floor inside an indexed annuity. These are not market gains. Market gains are not guaranteed. It's if the market is below 0%, if you have a negative rate of return in the market, typically the S&P 500, in any given year, you are still going to get credited 0%, and that is guaranteed. So you get this downside protection inside that particular product. So those are guarantees that you actually do get. So I put this analogy in here. I kind of like this. So misunderstanding annuity guarantees is kind of like thinking that your car's lifetime warranty covers everything forever, when in reality, it might only apply to specific parts under specific conditions and serviced at specific times during the life of your car. So you just really need to pay attention to what's guaranteed. That's not a big negative, by the way, folks. There are some good, solid guarantees inside of a lifetime guaranteed annuity contract. And they're there for a reason. Yes, you have some fees associated with the guarantees, and then it just comes down to, am I getting enough value for what I'm paying for that guarantee? And I think a lot of times you'll see that that's actually a pretty good value, especially with the contracts in today's world. So guarantees do apply if you annuitize. Annuitize, remember, is when you take that amount of money that you've got in the contract, and from that benefit base, at whatever age you decide to annuitize, they give you a payout rate. And that payout rate might be 5% or 6%, whatever it might be for that particular age. They multiply that times that benefit base, and then that's your guaranteed lifetime income forever. And so that stays there on the contract for as long as you and or your spouse live if it's a joint and survivor contract. So you do need to know the difference between the account value and the benefit base. So if you surrender a contract, you get the account value. You do not get the benefit base. A lot of times you look at these illustrations and you'll see the benefit base is bigger than the account value, at least under a hypothetical situation. And so people say, well, wait a minute, this benefit base is bigger. If I surrender, I'm getting a heck of a rate of return. I want that. That you're not going to get that. The benefit base, again, is that phantom calculation based on actuarial science that insurance companies use, but that's a good thing because they know the numbers and they know that they can afford to pay this rate based on this age and the number of people that are in that contract, and that's how you get the guaranteed lifetime income. And the other thing is that you just want to make sure that you're not misaligning your guarantees with your actual needs. And what I mean by that is you can get into, let's say, for example, a fixed indexed annuity, and you can say, you know what, I do want to take money out down the road, but I don't need it right now. So I'm going to take it out maybe 5 years, maybe 10 years, maybe longer. So you have to decide, do you want to actually pay the fees for an income rider? Because it could be 0.5% to 1% per year for that rider, but you get the peace of mind knowing that you've got a guaranteed income. And it's a good income, don't get me wrong. But if your actual need is that I don't need to actually fill any gaps, I just want the ability to take money out, and maybe only at certain times, maybe not every year, maybe not every month, starting in year X, then don't get the guaranteed rider. Just get the annuity and get the most bang for your buck based on the payout or based on the rate of return on the S&P 500 over a period of time, and then you can look at withdrawals. And again, remember, withdrawals during that surrender charge period is only going to be 10% per year, not cumulative. But once you're past the surrender charge period, then you can take out 20%, 15, 30, 50, whatever you want. So you got a lot more flexibility under that scenario. So those are the things that you really need to know when it comes to misunderstanding guarantees. All right, mistake number 3, buying without comparing contracts. And folks, this is like, I guess the analogy is that this would be like going out and buying your first house and ignoring or not checking out the neighborhood, or not paying attention to the inspection report, or not checking the prices of similar homes in the area. So you want to make sure that you're looking at a couple of different contracts. And I say typically look at 3 different companies and make sure it's apples to apples. Make sure you're looking at either immediate annuities, 3 immediate annuities from 3 different companies, 3 indexed annuities from 3 different companies, because a lot of them, they just have different rates, different benefits, different fees. And then you just want to make sure that, again, you're getting the best value for the money that you're putting into the contract. And obviously that's in large part what we do. We search and we go through, and we have software that basically searches every annuity available under a given set of parameters, and then we can start from there. So you just want to make sure that you don't overpay or that you get a contract that underperforms just because you didn't compare. So that's why we always say look at 3 different companies. You don't want to be in a situation where you bought something and you find out from friends that, man, I bought a contract for the same amount of money, same time you did, and they're getting way more bang for their buck. It's just doing your due diligence. So again, that's mistake number 3, buying without comparing the contracts. So what you need to do, like I said, make sure you're doing 3 different contracts. Make sure you're looking at apples to apples. Use a licensed independent advisor, not just a captive agent. And if you don't know what that means, a captive agent is somebody, we have a lot of them in this industry, good people, they just work for one company. And they get paid to sell that one company's product. So that's what's called captive. They cannot go out and sell outside of that window. I'm an independent advisor, so I have access to all the products that are out there, and I get paid by the insurance company. It's not an additional fee that comes out of your pocket. It's already baked into every single contract. But then I get to look at all the different contracts and do the best due diligence I can for you, versus just looking at one company. And the problem with just the one company is not that it's not going to be a good contract, but it might not be the best contract. And frankly, it's a little bit of a sales bias because you're only looking at one company. And then you want to look beyond the payout amount. You want to look to see if the liquidity, the inflation protection, the death benefit, does that all fit your needs? Do you need that inflation protection? Maybe you don't. And again, we walk through that. We want to see like what's your longevity? What kind of runway do you have? Do you have a family history that you could live well into your 90s? Well, maybe inflation protection makes a lot of sense at that point. Understand what the liquidity features are, getting back to the withdrawal provisions. And then, of course, check the credit ratings in the insurance companies. You always want to do that. AM Best, Moody's. Frankly, we don't work with any company other than A-rated or better. We don't get into the B+, B++, triple Bs, anything like that. They have higher payout rates. They have higher interest rates. They have some higher guaranteed benefit bases. But they have things that aren't guaranteed. And we just want to work with companies that have been through it all, been through all the economic ups and downs, all those cycles, and have proven that they can do it over time. Those are the companies that we like to work with. Mistake number 4, ignoring income rider costs. And by that, I mean, you're looking at a guaranteed income rider or a long-term care rider or a death benefit rider because I want death benefit protection or I want inflation protection. That's fine, but let's just make sure you understand the cost. Buying it with it versus not buying with that rider. And then look at what that really does do to the contract and what it does to your flexibility, or conversely, what it does to your peace of mind. Because if it's got flexibility, but it's a little bit more risky, maybe you want to stick with, let's say, I'm okay paying for that rider, as many people are, to say that I want this guaranteed amount of money. I want to fill that gap that I've got between my Social Security, my small pension, that amount added up versus, the expenses that I've got every single month. So they're not free. Rider costs can typically range 0.5% to 1.5% annually deducted from your account value. So again, that's not all that unusual. Most of them I would say are 0.5% to 1% at the most. That's very typical even with 401ks, mutual funds, ETFs, things like that. So these costs are always there, but you just need to make sure that you understand them when it comes to a rider, because you don't have to add the rider. The rider is something that is there to serve a specific purpose, and you just want to make sure that it actually aligns with your needs. Remember the guaranteed income? We talked about this. It's based on a phantom value, but it's only used for income calculations, so it's not an account that is available for withdrawal. So I talked about that a little bit ago. So you've got the benefit base and you've got the account value. If you surrender the contract, you're going to get the account value. You're not going to get the benefit base. And sometimes that benefit base is larger and you're wondering why you're not getting that number. That's only used for calculations for your guaranteed lifetime income. So you just need to be aware. So what do you ask and compare? Ask if the rider's optional or built in. Some contracts have them built in. It's already what we call baked into the contract. Doesn't mean there's not charges, but it's already baked in. So you just need to know if it's there, or if I'm adding it, then I'm going to pay this additional fee. So some contracts, they have terminal illness riders that are already built in, chronic illness, terminal illness that are already built in. Some have long-term care riders that are already built in. Trust me, they always build in some sort of cost within that. You may not be able to see it. I won't be able to see it either. If I can see it, I'll show you. But if we can't see it, we just know that it's part of the reason the final number comes out to what it is. And then we look at those numbers versus other companies to say, all right, this what looks better? It's kind of like the old eye test, number 1 or number 2, number 2 or number 3. Compare the fees versus the benefits. We've talked about this a few times, but that's the whole idea. When you're going through this, you just want to make sure that you're looking at all the fees and looking at all the benefits and saying, okay, I'm okay with that value, or I'm not okay with that value. If you're okay with that value, then you move forward. If you're not okay with that value, we shift gears and look for something that makes more sense. And then lastly, make sure you actually need guaranteed income. And I touched on this a little earlier. So, if you're in a situation where you don't have a income gap that you have to specifically try and fill, but you like the idea of getting some income down the road, why buy the rider? Why pay the fee if you're going to have the flexibility to say, I'm going to take a contract that's got a little bit higher cap rate on it, so I'm going to get a little bit more bang for my buck. No, I'm not going to be able to take out a steady stream of income. I'm just going to take out withdrawals every other year, whatever that might be for. Vacations, college education for the grandkids, whatever it might be. It's flexibility versus guaranteed. Neither is right or wrong. It's just what's best for you. And mistake number 5, buying without understanding the exit strategy. So this is a good one too, because people sometimes really don't understand what happens if they move the money, cancel the contract, or pass it on. So you just want to make sure that you've got an understanding of what the exit strategy might be, and that exit strategy might be as simple as the exit is really just getting the guaranteed lifetime income. Or the exit is I'm going to start taking withdrawals when I'm 75 years old. Or the exit is I'm just going to pass the contract on to my spouse when I pass away. So a lot of the misunderstandings are the taxation, what happens, and that really does depend on the contract that you buy. So that's a much longer presentation. That's more specific to which type of annuity that you buy and then how you structure it. An indexed annuity, a lot of that's going to come out to the payout rates and how you've structured that, how that money's going to pass, and then whether that's taxable or not. So we're talking period certain annuities versus joint and survivor annuities, things like that. But we just have to walk through that and make sure you understand. Again, these aren't deal killers. This is just to really understand what you've got, because if you understand it, you're going to feel much more comfortable down the road. Also, not knowing the process to annuitize versus taking withdrawals. And I've actually touched on this, I think, twice already. And that's just, do I take the guaranteed income? That's what annuitization is, where it gives you that set number forever. Or am I going to just keep the flexibility and take money out when I need to take money out? Simple as that. Believing that you can trade out easily. Now, you often can trade out. And by trade out, that typically means that you want to move a contract from one company to another. That involves a 1035 exchange. It has to go from a like contract to a like contract. And people do this all the time because sometimes newer contracts come out, now with a little bit higher interest rates than what we had 10 years ago. Sometimes it just makes more sense to move that contract. The surrender charge period is over, so there's no big hit to you. That can make sense to do it. But if there's penalties, then we have to kind of step back, reel it in, and say, do we want to do this? So bottom line, the analogy that I like to use with this buying without understanding the exit strategy is like boarding a one-way train without checking where it stops or even if it stops. So know your liquidity options, know the surrender charges, understand those, know the tax consequences, understand the rider rules, and you're going to be a long way towards really understanding what you're getting. And it's really just trying to get to a comfort level. And that's what we want to do, is make sure that you're at a comfort level when you get into any of these. So the exit strategy list, define your time horizon and liquidity needs, know the surrender period and charges, understand the free withdrawal rules. We talked about that, 10% per year, not cumulative. Learn the tax impact of early withdrawal if that's something that you end up having to do. Ask about any kind of rider restrictions. Does the rider change, go away? What has to happen to trigger a long-term care rider? Things like that. And then identify special exit clauses. And that again gets to like nursing home, terminal illness, passing away. A lot of contracts have special clauses. They don't charge for this, and you are allowed to take out maybe up to 50% of the money if you qualify for a nursing home, or if you become terminally ill. You can get up to 50% of the money, no questions asked. And it doesn't matter if you're in the surrender charge period. And then when you're working with us, run some what if scenarios. And that just is basically saying, okay, what if I put in this amount? What if I took the money out in year 10? Or what if I put in this amount and I took the money out in year 7? What does that look like? And then just get an independent review, which again, that's talking to us. We are independent. So we're going to review all these contracts. So we're going to review what the best company looks like for your situation, and what makes the most sense. And then put your exit plan in writing. You put your exit plan in writing, 5-10 years from now, you're going to, it's going to give you some recall to say, oh yeah, this is why I bought it. I think it's actually a really good idea. We've tried to do that. Not everybody does it. I think it's a great idea. Final tips, just some spark questions to ask before you buy. And again, we kind of talked about these. So surrender periods, what exactly is guaranteed? Just make sure you do all of these things. You can go back and look at this video again and see those. So I don't want to be too redundant there, but these are the things that you want to make sure you understand. So we appreciate you taking the time. If you want to just work with us in a free, no obligation consultation, there is a link in the description down below the video that you can just copy and paste into a browser. My calendar will come up. You can schedule a time with me, and first call is really just to get to know each other, understand what you're trying to accomplish, what your, maybe a little bit about your risk tolerance, just exactly what that strategy will look like will happen after a couple of phone calls. So I'd love to do that. Again, no obligation, just to get started. My contact information, there's my phone number and my email address. So, if you just want to give me a call and ask a question, feel free to do that. That's fine. If I don't pick up the phone right away, I guarantee you I'll get back to you within a half a day. And then there's my email. You can also text me. So I'm savvy enough to do all of those. So we'd love to help you any way we can. Again, our goal is to just make sure that you're comfortable and that you make the most informed decision that you possibly can. So thanks for watching, and let's just get set. There should be a little prompt there for the next video, part 3. Talk to you soon.